Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. More economic news out late last week to give us a little bit of a clue as to where this economy is headed. And our panelists weigh in. Panelists this time around include Shiraz, the research director, Mian, Tracy, the stock strategist, Reineck, and Kevin, the market technician, Matris, all with us on this edition of the Roundtable. So 2.8% growth in the fourth quarter of last year, Shiraz, fastest growth in, what was that they said, year and a half, something like that. Yet, everybody gets the feeling the devil's in the details on this one.
That's true. The headline number definitely is a big improvement for what we have seen over the last few quarters. But when you dig a little bit deeper, the quality of the growth is not there. In fact, most of the growth came from inventory investments. Very jumpy, very volatile number. We have it this quarter, may not be there the next. Corporate investments, which was a standout performer over the last many quarters, came sharply down in the fourth quarter. And consumer spending, which many of us were banking on would go to 2.4, 2.5%, was essentially unchanged from the third quarter's level. So yes, the headline number was very good relative to what we have seen, though it was lower than expectation, but the internals were not that good.
Kevin M., you said you're happy with the number overall. Why?
Yeah, I liked it. 2.8% was pretty good, considering Q2 was 1.3, Q3 was 1.8, Q4 now being 2.8. And it is true, everybody is wringing their hands over the inventories, and they were a little higher than I would have liked. But if you take a look back at Q3, those inventories were way overdone on the downside. So I believe this inventory bounce that you saw was just kind of a catch-up move. And if you look at final sales for Q3 and Q4 were both up nicely, so I like the report.
Well, we have two more revisions to go. We're starting at 2.8.
Right.
Does that mean that we might see some volatility here, some big swings in these next two revisions?
I think so. If there is going to be a revision, I'm putting my money on the Fed. I think that the revisions are going to be up. That's what I think.
All right, Tracy, this report comes in the same week that the Fed announced they were going to keep rates low for a considerably longer period of time. So that implies some pessimism, and you think that we're at crisis levels, emergency levels, as far as interest rates, right?
That's the word I use, because we went down to this level during the height of the Great Recession, and we haven't come out of it. I mean, everybody's like, yay, we're still at these low levels, but this is not a good thing. I mean, the Fed is really, is basically saying we have to stay here for things to even be at what we're seeing right now, which isn't all that great. So to me, that what the Fed has said last week was not a good thing.
So let me throw this out for everybody's consideration then. Does that mean to imply the Fed has no more tools? They're done.
First off, I'm interpreting the Fed's zero interest rate policy as a good thing. The economy is like a tightrope walker, right? And there's no need in ripping out the safety net. You're going to freak out that tightrope walker. Let the tightrope walker, our economy, gain some more confidence. And I think them keeping the interest rate so low for an extended period of time is exactly what the market needs. And I'm reading good stuff in every single Fed report.
The hawks have left the FOMC. The inflation numbers are coming down. The Fed seems to be far less concerned about inflation than we had seen in the last few FOMC meetings. And this is a very dovish FOMC now. In fact, my sense is that the FOMC and Bernanke himself, they're not talking about it, but they're very concerned about deflation. And it's that fear of deflation that they are taking this insurance policy of lower rate longer and leaving the door open for another bond purchase or dollar printing or whatever call it.
But still the bottom line is going to equal sluggish growth going forward.
It's sluggish growth, and when you combine that with no pricing pressures, that's where you see the dreaded deflation thing come in the mix. And that's lower rates. Stock investors have always liked it, and that's what we are seeing in the market.
Tracy, if things are worse than expected, what is actually worse than expected? The growth side of the economy?
No, I actually think we're holding up better. That's why I like the 2.8%, even if it's not the real number, because over in Europe, I mean, things are not good over there. I mean, they're basically saying, you know, I just heard that France is saying we might not see hardly any growth for this entire year. You got like bad stuff going on over there. We're going to have a rough first quarter over in China. Then we don't know what's going to happen. Presumably they will bounce back off of that, but we don't know. And so we look good. So, you know, this kind of slower growth, but still growth, is a good result right now.
Yeah, I think 2.5%, 2.8%, 3%, this is fantastic because there's less excesses being built up into the economy, which means we should be able to grow for a longer period of time.
Yeah, the storm clouds though, seem to be building over Europe again.
Yeah.
And so we're going to have to wait and see going forward how that's going to play out and impact us over here. All right, we are going to be back yet with stock picks, top stock picks for the week from these folks. Stay tuned.